Next question. Reliance Limited has just paid dividend of rupees 8. Dear students, the term just paid stands for D0. Growth rate is 10%. So G is given to us. Market price of the share, MPS stands for market price of the share, is rupees 100. And there is a flotation cost of 3%. So flotation cost is also provided to us. Find, highlight the portion. There is a new point over here. Cost of retained earning and cost of new equity share. So we are required to make the calculation over here, KR and KE. That is the question. So I want you to make the calculation of the KE and put your answer in the chat box. Let us answer the question. Working note number 1, heading write down, calculation of KE. Very simple. Working note number 1, calculation of D1. It is D0 into 1 plus C. What is D0? D0 is just paid dividend, that is rupees 8. What is growth rate? It is 10%. So answer is rupees 8.8. That is the way the D1 is calculated. After calculating D1, calculation of K. K will be found as D1 divided by P0 plus C. What is D1? It is 8.8. What is P0? Current market price of the share is 100 rupees. And what is the growth rate? Growth rate is 10%. 0.088 plus 0.10. 0.1880. That is 18.80%. I'm sorry, I forgot to deduct the flotation cost. Flotation cost is given to us in the question. It is provided as 3%. So again, the question does not provide the face value of the security. So we make the calculation of the flotation cost on the market price. So 100 rupees minus 100 into 3%. So what will happen? It is 8.8 divided by 97. That comes to 0.0907. So that comes to 0.1907. That is 19.07%. Please write an answer. Now there is a new point, that is cost of retained earning. That is a new point. I request all of you to pay attention. See what happens at, say, in calculation of the cost of retained earning. In calculation of the cost of retained earning, how we are required to understand the concept. See, basically what happens at, say, a company is formed. A company is formed. The company is issuing equity shares, which investors are subscribing. So equity shareholders are giving their hard-earned money to the company. The company is doing business. Whatever the business that the company does, with that, say, there is, say, an amount of the profit. Whatever is the profit of the company, from that a certain portion of the profit is given to the shareholders and certain portion of the earning is reinvested in the business. Whatever is the total earning of the company, of that say certain portion of the earning is paid to the equity shareholders and certain portion of the earning is reinvested. So basically what happens at say, whatever the amount that say the company is reinvesting, for that equity shareholders are having a contention that whatever the amount that say you have reinvested, on that say we are expecting you to give a return as if say whatever the fresh investment that we have made, because basically we have taken the risk and we have given them our hard earned money to you. So whatever the earning that the company has say is basically belonging to us. Law prohibits us say to ask that amount from you. So whatever the amount that say you reinvest in the business, on that say we want you to give the return to us as if we have made a fresh investment with you. Because if at all you are not able to earn, give that amount back to us. We'll make investment of that fund somewhere else. So basically, in financial management, an argument is made, listen carefully, in financial management, an argument is made that retained earning is considered to be indirect investment made by equity shareholders. Retained earning is considered to be indirect investment made by equity shareholders. So on the retained earning component, so the company is, I'm sorry, on the retained earning component, equity shareholders are expecting the same return as if they have made fresh investment. So whatever the formula that we have, listen carefully, whatever the formula that we have for calculation of the cost of existing shares, exactly the same formula is applicable for cost of retained earning. Once again, we do not have to consider the flotation cost because the company does not have to incur any flotation cost for the purpose of getting retained earning. Let us answer the question. Retained earning is considered to be an indirect investment by equity shareholders. Full stop. On retained earning component, investors are expecting same return, same return as fresh investment by equity shareholders. Full stop. Equity shareholders want either company to earn on retained earning component or distribute the same. Full stop. In that, write down further, in calculation of cost of retained earning, we will ignore flotation cost. Full stop. So write answer, KR is equal to D1 upon P0 plus growth rate. D1 has already been found by us. It is, I think, 8 rupee 80 paise. P0 is 100 and the growth rate is again 10 percentage. So 0.088 plus 0.10, so 0.1880, that is 18.80 percentage. Now a small note I am dictating to you that we will understand later on. Write on in bracket, if information about personal tax rate and or brokerage is given, comma, calculation of KR will be different. What is this? I'll explain that in the time to come. But just when you are preparing the notes, everything should be prepared properly. That is the reason I have dictated this note to you.